Hey team, thanks for checking out this video. Whether you're studying for the BEC exam or you're just trying to ace your college economics class, this video that harnesses the power of visual learning will simplify the law of supply and demand, and you'll learn about the various types of elasticity measures. Now for you CPA candidates, if you're studying for the BEC exam, sign up for a free trial and you'll receive access to the study guide as well as multiple choice problems on this topic, along with every other topic tested on the BEC section of the CPA exam. If you haven't tried us out yet, well, Universal CPA offers a free 14-day trial with 100% access and no credit card is required. We're just out here grinding to help you pass the CPA exam. So even if you want to pop in, use the platform for 14 days, we're fine with that. That's completely fine. So where do you sign up for this free trial? Well, you can visit our website or visit the link that's in the description of this video. And you'll notice we also have links to our Facebook study groups. Students have found those to be super helpful. So if you're interested in purchasing our platform, have any questions, would like a demo, please reach out to us and we'll get you rocking. All right, now let's go ahead and watch this lecture video on the law of supply and demand. So in this module, we're going to start by talking about the law of supply and demand, and then we're going to shift to elasticity of demand and supply. So when it comes to the law of supply and demand, it basically says that these two separate laws work together to determine the optimal price point of a product. So as a general rule, if price increases, then supply will also increase. However, because it's more expensive, consumer demand will decrease, right? Think about it. If the price goes up, well, more suppliers want to sell that product, but over time, demand will fall because we don't want to pay that higher price. Now, on the flip side, if price were to decrease, well, suppliers, they don't want to sell something that has a decreasing price, so supply will go down, but because it's less expensive, demand will go up. Now, these two factors or these two laws, they always work together to eventually try to find a market equilibrium price, which is where supply equals the quantity demanded in the market. So we'll get to this a bit later, but I just wanted to visually show you what market equilibrium is. And it's when supply and demand perfectly align. And you can see there's no surplus and there's no shortage in the market. So the supply perfectly matches the demand, and that means for every bit of units supplied by suppliers, well, there's enough demand in the market to buy it, right? And that's called the market clearing price. So again, we'll get there a bit later. Now, if you think back to your college courses or if you've used another review course, probably all you saw was the supply and demand curves. And while those are great, it's more important to just focus on what actually impacts demand and what impacts supply. Because from a theoretical perspective, that's what we need to understand, not necessarily, how these curves shift on a chart. So let's start by talking about what changes demand. Now, pricing can change demand, but there's also other factors that can change demand. So let's start with the pricing impact and the result on demand, right? So as we saw in our laws of supply and demand, well, if price increased, demand goes down. If price decreased, demand goes up. So what are the two main reasons? Well, the two main reasons are the substitution effect and the income effect. So the substitution effect and the income effect, they just mean the same thing. If the price of one good goes up, I might switch to another good, right? Like switching from Cabernet to Merlot, since Merlot is a little bit cheaper. Same thing with the income effect. If my income stays the same, but that sports car gets more expensive, well, I'm going to have to shift to something that's less expensive, right? So in both cases, right, again, if price increases, the demand for that product will go down and I'll either substitute it with another product or I'll get a different run altogether, right? But if the price were to decrease, well, then the demand for those products would go back up, right? So that's how pricing can impact demand. Now, we'll quickly talk about other factors that impact demand that are not related specifically to the price of that product. So we have our visual here, right? Well, the first item, price change of related goods. So related goods in the market could change in price, and that could impact the demand for our particular product that we're focused on. How about the number of buyers in the market? Well, if the population of buyers increases, right? Let's say that our target market is ages 25 to 30. And last year there was only 100 people that were 25 to 30, but now there's 200. Well, that's going to increase the demand. Changes in wealth or income level, that can also increase or decrease the demand of a particular product, right? If the overall wealth in the market increases, well, all of a sudden now we can afford more expensive products. So that could impact the demand for whatever product we're looking at. How about consumer trends or preferences? Well, we've seen how marketing or influencing can make a product very popular, or it can also make it very unpopular, right? So that can artificially shift demand as well. The last item here is consumer expectations. So as consumers, if we think the price is going to increase or decrease, and the supply might also change, well, that could impact the demand today, right? So let's say a hurricane's coming and we think there's going to be a huge shortage of water, right? We might go out and buy water today. Well, that's going to increase the demand for water today if everybody else thinks the same way, right? So whatever we expect to happen as consumers, that can impact demand as well. So we've talked about factors that impact demand. Now let's talk about the factors that can impact supply. So aside from price, right, because price does impact supply, right? Whatever price the suppliers think they can get in the market, that's going to impact how much supply they want to create. But there's other factors that also impact supply. So the first item is a change in production cost. So if the cost to produce a product increases, well, as a supplier, unless I can get more money for that, I'm going to actually create less. However, if the cost to create a product actually goes down, right? Maybe material gets less expensive, or, labor costs less, and I can still get that same selling price, well, then I'm going to supply more to the market, right? So a change in production cost can definitely impact supply in the market. Now this one's a bit related, but a change in manufacturing method. So let's say that new technology comes along, or just a new manufacturing process that makes it more efficient to produce more. Well, if I can produce more at relatively the same cost, then I'm going to end up with more supply in the market. So that can impact supply. So we already talked about how changes in price or demand of related goods impacts demand. Well, that can also impact supply. Also, forecasted changes in supply, right? If we think the market's going to improve or get worse, that could increase or decrease the supply of a specific product. The last item that could impact supply is just changes in regulation. Now, this regulation change could be related to taxes, laws, subsidies, right? But that can increase or decrease supply. So we have to think about how changes in regulation impact the economy. So now that we've talked about all the factors that impact demand and all the factors that impact supply, well, let's go back to our supply and demand curve, because in a market, over time, those fluctuations will sort of level out, and we should get to market equilibrium, which is when demand perfectly equals supply. And then that is when we have a market clearing price. Now, the government can also come in and have price ceilings or price floors, and that can impact the market equilibrium, right? So an example of a price ceiling, that's when a price is set at a certain max. Now, if that price ceiling is below the market equilibrium, well, that's going to end up creating a shortage because the price is lower than really what the market is willing to pay, right? So it's going to go real fast. However, we can also have a price floor, which is a minimum price. So think something like wages or tobacco or alcohol, right? It can't be below a certain price. Well, if that floor is above the market equilibrium, then we're going to have a surplus because we are required to pay more for something that the overall market says this is more expensive than it should be, right? So we're going to end up with a surplus. So overall, right, we've talked about the law of supply and demand. Definitely need to know this for the exam. Focus more on the theory behind what drives changes in demand and supply, right? Rather than focusing, does this curve shift left or right or up or down? You've probably heard the term elasticity, and elasticity measures how changes in one variable affect a change in another variable. So there's 4 types of elasticity measures we're going to talk about. That is the price elasticity of demand, the price elasticity of supply, cross elasticity, and then we'll talk about income elasticity. So let's talk about the price elasticity of demand, and this just focuses on how percentage changes in price affect the percentage change in demand. So here's the formula. It's going to be very simple, right? Price elasticity of demand equals the percent change in quantity demanded in the numerator divided by the percent change in the price point. So ultimately, when it comes to price elasticity of demand, we're really just focusing on whether the product is elastic or inelastic. So as you see in our visual, well, if the percent change in demand is greater than percent change in price, then it's elastic. And if we think back to that formula, well, we would end up with a number that is greater than 1. So if it's 1.5 or 2 or 3, well, that means the percent change in demand is greater than the percent change in price, and that is an example of an elastic good. So what is an example of an elastic good? Well, that's going to be watches or cars or clothes. And it basically means that if the price is changed, you're going to see a bigger change in the demand, right? So if the price goes up 5%, well, that's going to decrease the demand by more than 5%, say 10% or 20%. Now, you also could have the situation where the percent change in price is greater than the percent change in demand, and that is an example of an inelastic product. So what are some examples of inelastic products or goods? Well, think about it, right? The price changes, it doesn't really impact whether you buy it or not, right? You still need it. So some examples include gas or salt, medicine, could be corn, right? So think about that, right? And just in terms of your general life, how much do you focus on price when determining whether you want to buy it? So if the good's inelastic, well, then the price elasticity of demand in our formula is going to be less than 1. So that could be like 0.5. Now, the key thing to remember in every situation when we calculate the price elasticity of demand, we're always going to use absolute values, right? It doesn't matter if it's negative or positive. What we do need to remember is going back to that law of supply and demand. If the price increases, well, the demand is going to decrease. If the price decreases, then demand will increase, right? So they're always going to move in opposite directions. So one thing the exam does like to test us on is the relationship between elasticity and total revenues. So we have this little visual here that summarizes it, as it basically says, if it's elastic, meaning it's greater than 1, well, the impact of that price change on revenue will go the opposite way, right? So if we increase the price, total revenue will decrease. If we decrease the price, total revenue will increase. Now, if the product is inelastic, then it has a direct correlation with revenue, right? So if we increase the price of an inelastic product, it's going to increase overall revenue. If we decrease the price of an inelastic product, then it's going to decrease total revenue. So while other review courses would tell you just memorize this visual, I'd rather you focus on determining how to do an example calculation on the exam so you can double check your understanding. So in this example, let's say that Big Mountain Gas, they currently sell 100,000 gallons at $10 per gallon. But they want to increase the price per gallon by 10%. So that price point is $10, and a 10% increase, that brings it up to $11. Now, if quantity demanded was 100,000 gallons and they say, okay, we expect demand to drop by 5%, well, then after that, the demand's only going to be 950,000 gallons. So if you do the quick math, right, the change in 5% divided by the change in 10%, that means our price elasticity of demand coefficient is 0.5. So now all we need to do is figure out, did revenue increase or decrease because of this price change? Well, if before we had 100,000 gallons at $10, that means our net revenue was $1 million. But afterwards we had 950,000 gallons at $11. Well, that is 1,045,000. So actually our revenue increased by 45,000. Now, if we look back at our chart, the only way we can increase the price and increase total revenue is if the good is inelastic. Well, gasoline is generally inelastic. And when we did our math, right? When we divided that 5% change in quantity by the 10% change in price point, well, that had a coefficient or an implied elasticity of 0.5. So that confirms for us that the gas is inelastic. So one last thing here that we didn't talk about was unit elasticity, and that is when the percent change in quantity demanded is perfectly equal to the percent change in price, right? So our implied elasticity would be equal to 1. Now, how often do you think that occurs? Well, not that often, right? It's like seeing a unicorn, right? So when it comes to unit elasticity, remember the unicorn, and there is no change to overall revenue because it's aligned perfectly with the change between demand and price. So there you have it. We've talked about our first elasticity measure, which was price elasticity of demand. Again, it focuses on how changes in price ultimately impact demand. And just remember, they always move opposite directions, right? That's just the law of supply and demand. Now we're going to talk about the price elasticity of supply. So if we think back to our law of demand and supply, well, when the price increased, the supply increased, and when the price decreased, the supply decreased, right? Now the formula for the price elasticity of supply, very similar to the price elasticity of demand, except we're talking about supply here. So once we do the calculation using our formula, we'll get a result. And if that coefficient is greater than 1, that means it's elastic. If it's less than 1, it's inelastic, right? So very similar again to the price elasticity of demand. So when it comes to the formula here, well, you can see the percent change in quantity supplied. If that's greater than the percent change in price, then we have an elastic product. If it's not, right, and the percent change in price is greater than the percent change in quantity supplied, then it's inelastic because it's less than 1, right? So when it comes to price elasticity of supply, very similar to demand, except we're focused on the supply side of it all. Another great elasticity measure to understand is the cross elasticity of demand or supply. Let's quickly touch on the formula because it will make a lot more sense. So as you can see, the cross elasticity of demand or supply, well, that's equal to the percent change in quantity demanded supplied of product A divided by the percent change in price of product B. So basically what we're doing, we're trying to assess whether a change in price of one product ultimately impacts the percent change in quantity demanded or supplied of a different product. And so what this formula can help us do, it can help us determine if the goods are substitute goods or if they're complementary goods or if there's just no relationship at all. So as an example, let's say we have a restaurant here and the restaurant decides to increase their prices. Well, if the price increases, we know the demand's going to go down. Now, the question is, how is the quantity demanded at the grocery store impacted, right? Will it go up? Will it go down? Is there any impact at all? So what we can do is we can use this formula to help us understand whether the grocery store is a substitute good for the restaurant. Are they complementary, or is there no relationship at all, right? So obviously we're talking about a very high level here. You could do it at a specific product level to see, are the goods substitutes, are they unrelated, or are they complementary? So on the exam, you'll probably have to calculate the cross elasticity of demand or supply for a given scenario, and you'll end up with the figure, and you'll have to determine, does it represent a substitute good or a complementary good? Well, if it's greater than 0, that means it's a substitute good. And again, you can think about it as the percent change in price is less than the percent change in quantity demanded, right? So similar to an elastic product, meaning, if the price of that goes up, well, people are going to switch or substitute it with another product that is probably cheaper. Now, if the result of the formula is a number that's less than 0, meaning it's negative, then that means the two goods are complementary. So a percent change in price will also increase the percent quantity demanded, or if there's a decrease in price, it's also going to decrease the quantity demanded, right? So they work together, they're complementary goods. And then if it's equal to 0, that means there's no relationship at all, right? So probably pretty unlikely. So that is the cross elasticity of supply demand. Just remember, when you see cross elasticity, we're comparing or trying to understand the relationship between two products, right? does the percent change in price of one product ultimately impact the percent change in quantity demanded of another product? The last elasticity measure we're going to talk about is the income elasticity of demand. So this just focuses on our income level. If our income goes up, how does that impact the quantity demanded? If our income goes down, how does that impact the quantity demanded, right? So you can think about it as if I make $100,000, but all of a sudden now I make $150,000. Well, how does that impact what I want to buy or the quantity demanded? Because there's going to be certain products that now I might buy because I have more money, and certain products I no longer buy because I have more money, right? Or maybe it doesn't impact anything at all. So the formula for the income elasticity of demand calculation is just equal to the percent change in quantity demanded divided by our percent change in income level. So we'll either end up with a positive number, a negative number, or something that's equal to 0, right? So if it's greater than 0, that means it's a normal good. And this basically just suggests that as our income increases, so does our demand for those types of goods. Now, if it's less than 0, that means it's an inferior good. And as our income increases, our demand for that good actually decreases, right? Because we have more money now, we will no longer need to purchase that. And then lastly, if it's equal to 0, that means there's no relationship, but again, that's unlikely. So overall, when it comes to income elasticity of demand, well, just think about how your buying preferences might change if you increased or decreased your income, right? Where would you sort of cut back? Where would you buy more of, right? Just think about it from that perspective, and income elasticity of demand will make a ton more sense.